Before we dive into today's podcast, I just wanted to say a big thank you to our new sponsors of the next few episodes, and that's SumSub. If you haven't heard of SumSub, they're a global AML, KYC, and KYB solutions business operating not only here in South Africa but across the continent. Great business, great group of people. Got to know them really well over the last few months, and a big thank you to the entire team for sponsoring Talking Success and the next few episodes. So if you are looking for any compliance solutions around AML, KYC, KYB, give the guys at SumSub a shout. You'll be in safe hands. So thank you very much and enjoy the show. Hi everyone, welcome back to Talking Success. We've had a bit of a kind of hiatus, I think, for the last few weeks. Not because we can't find any great guests, because there are plenty out there, but just been busy with so many different things. And just a couple of days ago, we were at the Central Bank of South Africa, the SARB. I had a big event in Johannesburg, which was really enlightening. It really was. Lots of innovation happening in terms of the payment systems, in terms of modernizing infrastructure, and some really exciting things planned. So watch this space. We're hoping to get a couple of the regulators even onto the podcasters, as long as they can get approval from the powers that be. But anyway, we're not talking about regulators today, although we probably will touch on a bit of regulation. I am joined by a very significant player in the market called PayJustNow. PayJustNow is a BNPL provider, but do things a little bit different, and certainly came to fruition and came to the market in a very unique way. I had the pleasure of chatting with Mark, who joins me today. Just a few days ago, we were talking about, what sort of topics can we raise, and like all of these things, when I do panels at these events, you tend to find that when you have these kind of pre-chats, actually, that's kind of the nuggets of all the information. So I had to stop myself from asking a load of questions that I already had kind of lined up. But what I really want to explore today with Mark is really the dynamics around BNPL, how that's evolving, how it's evolved, and I know, because I had a chat with Mark, some of the data that's coming out in terms of user bases and how that's kind of morphed and how that's changing is very unique. It's not something that I had really considered in terms of the types of consumers that are taking this product now and are really growing with it and helping them, in all sort of facets of life and financial well-being. So I'm delighted to have Mark. Sorry, I've spoken for loads. You're just sort of sitting there looking at me. It's great to have Mark on board. I hopefully at one point in my life I will grow a beard like Mark, but I have some challenges when it comes to growing hair, other than on my chin. But anyway, Mark, maybe you can give us some tips, or you can tell me where you go to get that very nice sort of looking beard there. So listen, Mark, thanks again for joining. I appreciate you. You guys are super busy. We're coming up to silly season as well. And where are we? October, 4th of October, and we've only got 8, 9, 10 weeks, however it is, till it's kind of Christmas. And I imagine in your world of BNPL, it's probably quite a busy time. But listen, again, thanks for joining. If you don't mind, could you give a quick intro in terms of you first, and then a bit about the business, PayJustNow, and then we can delve into some sort of topical questions and talk more about what we discussed the other day.
Yeah, 100%. Thanks again for having me. I mean, it's always a delight to be able to talk about the things you're passionate about. And although you see it as a bit of a hiatus, I kind of had a quick look to see who I was coming in after. And Brian Urbana is no small feat to come and to follow on from. So, thanks for teeing that up. I was pretty comfortable until I saw that.
Let's start with your sporting expertise then. Yeah.
So PayJustNow has been around 5 years now. It's hard to look back and see where all this time has gone. We sort of started late 2019, and PayJustNow as a product and a platform has evolved so dynamically since then. Following our sort of brief sort of chat a couple of days ago, I was trying to think about some of the skeuomorphisms, that I can touch on to kind of drive home that things are constantly evolving. But that said, as a co-founder of what has fast become a very popular payment option. Gives me personally like immense pride to be a part of this journey. And like if you sit back and think about it in a quiet dark room, you know, it manifests in how people have embraced it, because of what it does for them in their personal lives, and you know, as they budget and meander their ways through the daily grind, you know, in a tough economy, ostensibly where you know where unpredictability is you know it's disharmonious, and I think the secret sauce, if I just had to speak ethereally about PayJustNow, is it takes that unpredictability out when it comes to one small part of your consumer journey. You know, it gives you something that you can see. It is what it says it is, and you can plan. And that predictability is kind of psychologically at the core of you know of human nature. You know, you want something that is familiar, but you also want the capacity to be able to experiment and explore. And I think that probably is the most succinct message I wanted to try and land, as it relates to how has our consumer sort of profile sort of expanded so much in these last 5 years. You know, we kind of we didn't have anything on which to cut the cloth, so to speak. We took what was a pervasive and popular sort of payment method globally in established sort of economy markets like in Australia and in Europe, and we had to try and reimagine it to fit for the South African consumer. So like if I just think back to 2019, that was the hardest part, you know, to flatter the likes of Klarna and Afterpay, to copy them, you know, was the starting point. But we couldn't do it by splitting payments every 2 weeks like they do in Australia. You know, in Australia, if you're the CEO or if you're just an office worker, you get paid either weekly or bi-weekly or every two weeks.
Yeah.
So it fits that sort of economy profile. South Africa, people get mostly paid monthly, you know. And then on top of that, in Australia, the base interest rate was sort of like the low 2% at that time. You know, and we were at the low double digits, you know, and so it's try and squeeze all of the unit economics for it to make sense, to give our consumer longer to pay it back, and with a higher cost of capital. That was a real big challenge, and so we kind of again didn't have something on which to compare locally, so it was revolutionary. And in the moments of time from then to now, you know, we've probably got, I think, 3 or 4, probably the 5th one entering soon, if not already, competitors in the market. And so our evolution as one of the sort of first movers in this is to stay relevant. Our mantra being, you know, we believe strongly in survival of the fittest. But our interpretation of the word fittest is a little bit different to what you'd imagine. If you imagine someone beating their chest saying that they're the loudest and the biggest.
Yeah.
For us, survival of the fittest is so long as we continue to fit with our customer, then we will continue to be relevant, and our sustainability will be ensured. And the customer is also it's an important point to distinguish. Is we have a retail or a merchant customer. And we have a consumer customer, and the distinction between the two is we charge our fees to the merchant or retailer, and we offer this to the consumer free at that point of distribution.
Mark, let me interject there if I can. A couple of questions came to mind. So let's go on the first one in terms of, you know, obviously not costing the consumer anything, but costing the merchant, which is highly understandable. Given the even though, you know, we've had a drop in interest rates, a couple of, you know, basis points over the last few weeks or so here in South Africa, it is still, you know, a very high interest rate that, you know, consumers would pay should they be getting, you know, alternative sort of lending solutions, right? Whether it be loans, whether it be credit cards, whether it be anything else. When you looked at the economics and you compared sort of Australia or Europe, where again they're kind of single digit sort of interest rates. How does that work? It must be quite a complex got a model, because your charging mechanism for merchant again must be different to what Klarnas and the Afterpays and what have you are charging in other markets, because cost of capital is so much less expensive. How were you able to model that? Was that something that evolved over time, or did you have all of those computations done at the outset, and that's the model that you've stuck with throughout the 5 years, or has it iterated? How does that work?
Yeah, so our model hasn't really deviated much from our departure point. We've made tons of tweaks here and there.
Sure.
And that necessitated by a broadening of the type of retail partner that we have integrated with our payment services. It was easy to do it when a smaller retailer was prepared to accept a monthly sort of settlement for all of their transactions. And obviously the bigger the brand and the box store, you've got to try and fit in and comply with their sort of cash flow rules and that. And so we've got a spectrum of merchants that accept a lower fee on a monthly disbursement, and then a slight marginally higher fee on a daily disbursement. So again, there was no predefined rule set. So we had to develop a USP for the retail partner, for the merchant, that made sense. And at the heart of it, it was really piggybacking off what the profile in those established markets were, was that the target consumer audience was credit averse. They preferred to use a debit card. If they did qualify for credit, it was expensive in real terms to where in the environment that they're in. And in South Africa, obviously people are highly reliant on credit. But there is still that consumer that is credit averse. And if they are reliant on credit, it's to put food on the table and keep the lights on and the roof over your head. And so they would be technically classed, if I could make a sweeping statement, as underbanked. They could not use, they did not have access to cheap or cost efficient forms of credit to buy quality, durable products. So the compounding effect of that is we started with e-commerce first, which at that time had like around 2% of retail GDP was e-commerce. So we had a really small addressable market there. Somebody that was technologically pervasive. They understood how things worked. They favored the convenience, of just placing an order and waiting for it rather than schlepping it home. And it evolved from there to when we sort of broadened into an in-store payment tender type, to somebody that was putting things on lay-by, and they were paying monthly judiciously, but only got the product 4 or 5 months later. Sure. And mostly at a significant overhead cost to the merchant. So that was the USP for the merchant, was that we were able to allow them to realize the sale straight away, thus foregoing the overhead they'd have to incur holding it as a lay-by. And the evolution of that was a consumer, just the last point of that was they could buy better quality. And which meant that they didn't have to buy as often.
And I would guess as well, obviously you've got the quality side, and then there was the lay-by option. But people do still want instant gratification, right? It's quite rare that you go and you go, oh, okay, I really, really want that, whatever it may be, iPhone, Mac, whatever it could be. And actually, I'm going to put that away, and I'll get it in 6 months' time once I've paid it. People don't necessarily want that. Especially in the day in the where we live in current times, everything's about instant gratification. So to be able to offer that to people that perhaps were excluded or underbanked or underserved because of maybe their the sort of the culture, which I think we see here in South Africa and many other African countries or emerging markets, is yes, I'm banked, and South African regulators and people in the industry, go 80% of the population's banked, and that's wonderful. But what happens, we see every single month, is paychecks get paid into bank accounts. The following day, there's a line as long as your arm of people queuing up to go and withdraw their funds in cash, in fiat, and then put it under their mattresses, because there is a belief that that is safer, and there's not a great deal of trust in the banking system. Yes, there's lots of work being done in the background to try and sort of educate people that it's a lot safer, having your funds either on your phone or in your bank account rather than under your mattress or in your sofa. Won't mention any names there, but I think that there is a lot of work to be done, and that instant gratification to be able to go in and buy something and not feel that I've committed to this, and actually 2 payments in going, did I really need that? Or I found something cheaper, or I found something alternative, but I'm stuck now, so I can stop paying and I lose my money, or I kind of have to go through this process. So I can kind of understand that from a mentality perspective. But when we were speaking, Mark, a couple of days ago, you were talking about the demographics and sort of the shift of that, from what it was to what it is now. Can you talk us through that kind of timeline? And I know it's not necessarily documented, but early stages 5 years ago, the first, I don't know, maybe 1,000 customers that you had on, not merchant but consumer. What was the makeup there? What were the sort of demographics, and how has that evolved over the 4 years or so since then?
Yeah, so I'd say for our first sort of 18 months, we were largely, it was mostly female, so in the region of 75 to 80% female consumer user. That 80% was also in the sort of 27 to 35, 36 sort of age range.
Yeah.
And sort of the median was around sort of early 30s. And as the utility that PayJustNow has unlocked has evolved, if I just look at that 80% number again now, that 80% is distributed from 27 to 47. And it's still, the majority is still female, but it's around sort of like the 66, 67% mark.
Okay.
And with that, it was also really illuminating that, when you have such a narrow distribution, you kind of fall into that trap of building for the average. And when you build for the average, you kind of, you ring fence, the approach and the logic, to always be fitting for that very sort of narrow, that narrow subset. And so, tough lessons along the way, but to build for the average is not really an ideal approach. And again, in terms of which retail partners and merchant partners and verticals we pursue, we're in the very fortunate position now of consumers that signed up with us in 2019 and used us from that very young age.
Yeah,
we're largely using us to get their hands on the latest Air Jordans or leather briefcases, or a fancy weave, which I think we could both use.
Yeah, absolutely. Yeah,
I checked this morning, I checked this morning. They still don't have a man's version, but I'll let you know when it comes.
Yeah, please.
But their spend patterns have evolved now to not being about personal fashion and apparel, although that's still pervasive, but now also for the home. Fitting your car out with replacement tires, being able to split that into payments means I can do all 4 if they need it, rather than 2, one this month, one next month, and then 2 the month after that. And these sort of behaviors sort of emerge from as our utility broadens. And again, it's not for it. Buy now, pay later, and PayJustNow is no longer for the credit averse or the underbanked only, because everybody has a price point where it just makes sense. For one person, it could be a pair of shoes. In the middle of the road, it could be a washing machine, and then on the top end, it could be a sort of a jigsaw full set out from a from an outfitter where you can have something for your hobby, for the workshop. Even although it's been 100 and something days since we last had load shedding, which is great, by the way.
Yeah, yeah, absolutely.
In the beginning of the year, we were processing millions of rands worth of transactions for inverters and inverter, sort of sets. So, there is a point for everybody. It's not just for the underbanked or the credit averse.
No, I'll come back to that point in a second, Mark. Just one thing about the sort of the gender mix, because very interesting kind of data points there. Do you think that was because of? Well, okay, was that one of two reasons? Was it because of the types of merchants that you had on were more geared towards the female consumer, or was it that females felt more comfortable using a BNPL product rather than alternative means of credit cards, loans, etc., etc.? Do you have any data on that, or do you have any sort of ideas?
We have a view on it, and again, it's not a one size fits all. So there is a spectrum. Sadly, a lot of it is cultural, where that primordial responsibility for clothing the household, looking after the household, equipping the household falls on the woman in the household.
Yeah.
And I think our early sort of distribution of retail partners where we could offer utility served that to clothe you with quality clothes, to fit you out with the apparel that you needed, or the beauty care or the home products that you needed for your home.
Yeah.
So I think that still sadly in South African culture is the main driver. Secondly, we also find like the female consumer who's responsible for this budget is more judicious and frugal with it. She knows exactly what's going on, and she knows that to look after it, she needs to sustain it and manage it well. So the female consumer is she's less likely to default. And the other side is that also, like, if you have to manage a household's budget, but you wanted something for yourself, which was something we saw emerge, and there wasn't that much left over, being able to split it in three was the easiest self-justification, to splurge and get yourself that dress or that handbag or new shoes.
Makes sense.
And then from there, it just became about utility. Because if you were confident in it and the trust was there, and you suddenly saw that it was available, then it's something that you recognize, and it's safe, and I'm going to do this because it's there.
Yeah.
So the evolution of us being used not from need, but just from a simplicity perspective. And again, to that point, that very real point, that payday, everybody rushes to the ATM to draw their cash, because they don't trust it. Like, to not need to go to the ATM to draw cash, to do this right there and then, and still complete your checkout in a couple of seconds. I'm not going to be embarrassed at the till that this is not going to work is no longer in the back of the mind.
No, of course.
Yeah.
And you mentioned sort of the economics and things like that a little bit earlier on. Are you finding now that some of your consumers, again, not your merchants, but your customers on the other side, are slightly more mature, maybe slightly more financially astute in terms of financially, I'm not going to use the word literate, but financially aware, and can actually look at this and go, oh, okay, so I can spread my payment over 3 months, which means I can actually earn interest on, proportion of, especially if it's a slightly larger ticket item. Okay, like you were saying, I want to go and kit out my entire garage with, hobby kits or whatever it may be. A few 100,000 rand, I would imagine, and some. So if I'm spreading that over a period of time, 3 months, for example, I get that opportunity to earn interest on my holdings and my capital over that period of time. So are you seeing a slightly more astute consumer that's coming in and looking at it from that side? Actually, if I can kind of play this right, it's actually going to save me money rather than costing me any more like it would do in alternative forms of credit?
Yeah, I think, it would be lovely to say that, yes, that's the case, wholesale. I think that was a much more real sort of consumer thought process coming out of the pandemic, because South African consumers came out of the pandemic with a lot more savings than they went in. And I think that our sort of rapid the adoption of the consumer and our rapid growth post that period, you could logically say that this was a factor in a lot of the transactions decision making process. But the stats bear out that that higher level of savings that the consumer had coming out of the pandemic has quickly eroded. That on the back of the interest rates and inflation being very real, hitting even your wealthy sort of consumer, the bond prices and insurance and all of those types of things. I think for me, if your income is in the middle to the upper range in the spectrum, you probably are making those decisions, albeit sometimes I think subliminally, because the one thing I've come to realize about the South African consumer is that they've been highly conditioned. If you think back to traditional retail credit, it was they're getting the monthly statement in the post, open up that envelope, and it's a full A4 piece of paper, but you only look at 3 points that were all highlighted. It was current balance, minimum payment due, available to buy. And the mental arithmetic was, I take the minimum payment due and I add it to the available to buy, and this is now what I have as ammo for what I need this month. And one of the biggest challenges was to educate the consumer that we were not built like that. We were not normal. It's about, this is the installment. That's what the installment will be. That's the installment, the final installment. And only after that, the whole thing's available again. That was a conscious decision we made, not to make it a revolving, that your first installment's available to you again straight after the payment. Because it was that conditioning that gets the consumer onto that treadmill of just looking at those 3 data points and then making that decision from that perspective. But we've got professionals, we've got accountants, we've even got people from the SARB on our user base. So it's not the one size fits all. As a consumer spectrum, we all have the same problems at different levels. If buy now, pay later is interest free, that comes into your calculation initially, and then it becomes sort of like a back of the mind calculation going forward. And I hesitate to say that one other thing is the people with means as well, because of the trust in it, are more prone to experiment with retailers that look interesting and enticing, but they would not normally have just done it because they'd never heard of them before, and we're willing to, and that was phenomenal for how sort of the entrepreneurship and the new sort of online brands emerged post-pandemic as well.
Interestingly, I've just remembered a conversation that I had, I don't know, 3 or 4 months ago. I was at kind of a work group, and again, not from within our crazy world of fintech, just a kind of a focus group, and we were talking about different types of credit. And I remember the conversation about BNPL, and again, it was a mix of different people from all different walks of life. The general feeling was, no, it's too expensive. And I remember sitting there going, what do you mean it's too expensive? No, because they must load us with, with the cost, because, nothing's for free in this world. And I kind of sat back and went, well, no, that's not how it works. Obviously, I'm in the industry. I know how it works. The merchant pays those fees, right? But I think that maybe that's changed over time. You can tell me. But perhaps at some point there was a bit of, I wouldn't say distrust, but a bit of lack of clarity in terms of how BNPL works as a model for consumers. Because again, the amount of I'm no way. What I'm about to say, I'm no way suggesting that BNPL is one of these, right? But the amount of scams that there are, globally, certainly here in South Africa, there was a syndicate just the other day that was, found and prosecuted. People are a little bit unsure, I think, generally going, there must be a charge. There must be a hidden cost here somewhere, right? Now, obviously, we know there's penalties if you don't pay back. You don't hit your installments, and that's fine. But do you think the general population, understand the business model here is you don't pay because someone else pays, right? This is not for free. We're not creating this from thin air and doing it, for I don't know, a Nobel Peace Prize, but there is a commercial model here. Do you think there needs to be a little bit more education on that, or is that not a challenge you've ever seen?
No, definitely. That was actually our single biggest challenge, coming out the gate.
Okay.
Was, hey, we are what we say we are. And so we worked really hard on sort of social proof.
Yeah.
Because also, to get somebody to say, okay, I've done it once and it is what it says it is. That is the hardest part, because if it sounds too good to be true, I would even personally caution you. If it sounds too good to be true, it's normally too good to be true.
Yeah.
And we could have as many ads and posts and from us talking about it. I go back to, I think it was Seth Godin refers to like. To succeed, you need to be remarkable. And we can remark about it as much as we want, but nobody cares about what we say.
Yeah.
If somebody experiences it and makes a remark because it's remarkable, then it takes off. So that for us was the hardest sort of mountain to climb, because that mountain didn't have a path and we didn't know how high it was.
Sure.
And we could not have planned for how long it would take, but word of mouth was our biggest sort of partner in the early days, and then as brands that people trusted started integrating with us and choosing to have us at the till, it was that notional trust that was transferred from somebody that from a brand that was well trusted and well loved. They wouldn't do this if they thought it was going to hurt me. And then you sit back and you say, I bought something for 1,500 rand and I paid 500 rand installments. Now, if I bought it with my debit card straight, or my credit card, or if I bought it through PayJustNow, I would have paid 1,500 rand. And it's that realization that then is the tipping point. And I think that is in large part the reason why that over 80% of our monthly transaction value is processed by a returning consumer.
Wow. So you've got stickability, which I think
Yeah.
a lot of fintechs or tech companies or businesses generally want that. What's the stickability? How do I retain customers? Let's talk quickly about and I don't want this to be a regulatory podcast. There's more interesting things out there than regulatory and compliance, but it's an important factor. Now, BNPL here in South Africa is not currently regulated as a BNPL. You're not seen as a lender, from what I understand. Please correct me if I'm wrong. Whatever I'm saying.
We are regulated, but we're regulated as a provider of incidental credit. So we have to go through as much of the ringer as a doctor would. If you go into a doctor and you don't pay the bill, you're covered by incidental credit.
Yeah,
it's exactly the same process.
Okay, fine. So, and you're regulated by the NCR on that, or
Yes,
it's the NCR? Okay, fine.
Yeah.
But when you go and onboard a new consumer, what is that process in terms of KYC and credit scoring? Is there anything that's done there or not?
It's exactly the same as the doctor. He doesn't ask you for your credit report or have to do a KYC. And I think we were, again, there wasn't a cloth. A sort of a diagram on which to cut our cloth when we started this.
Yeah.
And the reality is that that put us in a position where we didn't have to invest significantly in all this massive overhead simply for the sake of being regulated. Although we were always sort of operating knowing that regulation is inevitable.
Yeah.
But we wanted to be at the table when that regulation was hashed out.
Sure.
Because intentional regulation is very important, especially when operating at scale and you've now suddenly got multiple players. Like there's no rule, so who's to say why follow this rule, why follow that rule? And that's where a player can come into the market and actually completely break the trust of the type of product it is. So I think it is inevitable, but it has to be done for the right reasons. Looking globally at some of the regulatory sort of processes that are being undertaken, a lot of it's being driven by the banks, saying you have to regulate this, and the lobbying from the banks wanting to get this regulated. Their intent there is to make it a little bit more difficult, to use BNPL rather than the traditional banking product. But I think we've kind of moved. The world has the economy, the world global economy's moved from there. The louder conversations right now are about open banking and interoperability. A decade ago, you had Visa and MasterCard that had this sort of monopoly, and the SARBs and the individual banks were never sharing any of their IP or their processes or their data. And the reality is that if you bank with two different banks, you've been KYC'd and all of that twice.
Yep.
At twice the cost to the South African economy. Which if you didn't have two costs for that would have been money that you had in your wallet still.
Yeah.
So I think the evolution of regulation and identity, sort of an identity product, is where the banks get to a position where they're not now protecting everything in terms of the KYC element. I firmly believe that if the banks had a joint KYC, and we're a bit more trusting, that this is, I'm using it for what it's worth, not creating it as a USP to compete against another bank. We'd be cutting mountains of costs out of our fintech, or sort of our financial business processes. But I think that's a beautiful thing to think about for the future. I think that's an innovation that would be a real big game changer.
Well, I'm not sure that's that far away. I mean, I was out for dinner the other night with someone that's working very closely with SARB on the DFID, digital financial identity, and that's essentially what this is going to allow consumers to have, or the population to have, is a central biometric ID, whether it's card, whether it's app. I don't know the details, but then not to have to go through KYC every 5 minutes whenever you want to go and do something, and you go, no, I don't have my ID with me or my passport with me, and no, I haven't. I'm not in a nice enough space where I can take a selfie, and I've got to look around the screen. It's done, right? And obviously authenticated through your ID or your passport, and so I think that's a reality. How long that's going to take. It was when
in Europe, it's already working. In the European Union, it's already there. It's just, in Africa and South Africa, I think we're a couple of footsteps away, and in innovation terms, that's not very long.
Listen, I was kind of all for this. I'm thinking this is fantastic, and this is actually relatively feasible. And then they kind of dropped the bombshell, which was, and we're working with Home Affairs. I thought, shit, okay, it's going to take a while, So anyway, that's the conversation for another day. So just to unpack one other thing for me, please, which is how you how do you allocate spending limits for new consumers that are coming on? Because you obviously, we've spoken about the underbanked and people that come in, get paid a salary, withdraw it into cash. There's no real data based on spending habits or anything like that. How do you allocate a proportion of allowance or funds to an individual coming on? Again, is that done through credit scoring through a TransUnion or what have you, or is that done on your own inbuilt or home built algorithms that then look at sort of credit risk and credit modeling?
Yeah. So again, it is a data-driven decision.
Sure.
It's evolved and it's a lot more intelligent than the one that we open the front doors with, so to speak.
Yeah.
We kind of modeled the spend facility initially based on what was the average sort of basket value transaction size in the e-commerce world. Obviously, as our portfolio of partners and the products that they sell and the price points that they land at has broadened so dynamically, we then sort of started relying on a lot more data points. Chief among them, the sort of the declared income that we ask you to tell us, and then the income that's predicted in the bureau report. But not just limited to that as an affordability decision, that overlaid with sort of what other factors are calculated by our algorithm to determine, can you afford an installment between each payday? And for us, the decision to make that facility a sort of a utility of value is you can only initiate a transaction and get your goods delivered in a few days or leave the store with your order if you make that first installment at the point of purchase.
Sure.
So from in algorithms you've got all these things, but you then don't have that that confidence score. But as soon as that first payment is made, it then upweights the confidence that that this facility is a serviceable monthly installment, so long as there's a payday between each installment that we ask you to make.
And then what about default rates? Clearly, it's something you have to factor in to your lending business, whether it's BNPL, whether it's credit card, whether it's microfinance, whatever it may be. What sort of trends have you seen? Are you able to sort of tell us what kind of default rates are kind of average in the market, and then perhaps how you guys are kind of aligned to those? Is it a big issue? Is it something that's actually quite manageable?
Yeah, look, I think as a percentage, again, that's managing for the average. You have lots of nuance to it. But if I had to just give you sort of like the helicopter view, sort of unsecured credits, typically in South Africa, the default rate is in the mid to upper 40% sort of mark.
Really?
And I don't know, I think I last looked at that a couple of months ago, so it hardly moves. And our default rate is below 2%. So again, I don't put that down to any sort of clever thing we're doing. I put it down to the social contract that it's free. If I know I'm in for interest, then a couple of days here and there, the interest calculation in my head is negligible.
Yeah.
And then it becomes less of a priority to service. And the longer you don't service it, the further you get into default. And that's kind of a you're on the side of the mountain there, and it's dewy wet, and then all of a sudden it's the water's running under your feet, and then you can't catch up.
Sure.
For us, it's free, and if you miss a payment, there is a late fee, because it costs us to try and collect.
Yeah.
But we also send reminders before payments are due. We also don't initiate the late fee the minute it's missed. So we do also give a grace period, and then before we try again. And it's only on that second stab, at the collection that a late fee is raised. And that's a genuinely authentic thing. Like we over communicate. So it's tough to argue when somebody has missed a payment that they get upset, but it's that social contract. And it also, because we've got such a high sort of portfolio mix of returning shoppers, it may have happened once or twice to one of them, but they know, listen, when I get reminded, it's a genuine reminder, and I've got some time.
Okay, cool. Mark, let's just wind the clock forward a couple of years. innovation happens so quickly, right? With everything you've mentioned, open banking and AI and machine learning and any other sort of topical technology there is at the moment. Who knows what's in store for the next 3 or 5 years? But where do you see BNPL? Where do you see PayJustNow? Where do you see? No, let's stick with those two. I was going to say, where do you see the economy? But yeah, that's not a short answer. So let's stick with the two that we can talk about, right? So where do you see the future of BNPL, and where do you see the future of PayJustNow in terms of evolution and in terms of keeping up? Obviously, you mentioned it's a competitive space, absolutely. How do you stay ahead? I'm not asking you to give any of your secret sauce away, by the way. So just high level wise.
Yeah, I think also we've spent most of this good time talking about the consumer, and the consumer deserves to be spoken to at this length. Trust me. There's a lot of pressure on the consumer that she has to deal with every day. That we kind of in true South African fashion, with our hybrid vigor, we just like it and lump it and just get on with the day. And the reality is that in the economy that we're operating in, that is under pressure from interest rates and inflation and low employment. One of the harbinger for me is and you can't really quantify it, so please give me some latitude here. But we've done just over 5 billion rands worth of transactions that didn't have any interest or fees on it. If you just do a matchbox calculation, that's how much money was left in somebody's wallet that they were then able to go and spend somewhere else. Sure. Now that's not something to sneeze at, and the consequence of that logically is that does contribute ultimately to employment. It does contribute to the value chain, to merchant partners being able to process more volumes, hold more stock, be more competitive. And at the same time, at the back of that heap of transactions, we've got such a wealth of first-party data on the consumer sort of purchase behavior, what they're looking at, what they like, what they walk away from. And I think core to this is a thriving economy is an economy with successful providers in the economy. With the exchange of money for goods and services, has a market. So the second part of this conversation, which is equally important, is we're not just processing a transaction for a retail partner at a higher processing transaction cost. There is genuine demonstrable value in that they are seeing a higher basket value. They're seeing an increasing frequency. They're able to leverage that to expand footprints, to upgrade stores, to broaden the SKU mix, to appeal to somebody, based on sort of even an aspiration or a need. The contribution to the merchant has allowed them to be more competitive. And in a time, this is like really important to make a finer point on, in a time where our sort of global retailers are muscling in on the South African economy. I'm talking of the likes of Shein and Temu. Now it's not just and I think it was Capitec's annual results where they said that last year Shein was the single biggest sort of retailer by spend by far, but Temu had only been operating for 3 or 4 months, and if Temu had a full year aggregated, they would have overtaken Shein. In their report, I remember something along the lines of that. So you've now also got a retail sector that is now highly under pressure and facing dramatic uncertainty in terms of, how much of the pie is left for us. And in that mad scramble down to zero, where everybody sort of like kicks off their marketing budgets, and what was spending 100,000 rand 2 years ago was getting sort of like 20,000 conversions. Now you're spending 100,000 and you're getting 2,000 conversions. So And that's completely out of your control. There's no visibility into who's seeing that ad, because you just set a budget on Google or Facebook, and you choose sort of the parameters that you think are relevant to who you think your consumer is, and you're off to the races. What we bring to the game is we're not Google or Facebook, so we know who your consumers are and what they're about, and what we think they're going to be about in the next phase of their consumer life. From shoes to home, to engagement rings to school stuff. That is a reality.
Yeah.
And on the back of that, unlike the banks, the banks know that the MasterCard was used at the till, but they don't know, what was in that basket.
No, sure.
So there is a sweet spot where, and this is not to be predatory on it, but it's to give demonstrably valuable data to the South African retailer, to equip them to be more competitive to the people, sort of scratching at the door. Although I'd say they probably made it all the way through the hallway already, but to be that much more competitive, and to help them say, okay, yes, it's fine, go and experiment with all of this, but we're a brand that you trust, and you will come back to the things that are safe and familiar. You've just got to weather that storm, and then on the back of that, any modicum of success with helping the South African retailer, sort of keeps the money in the country, keeps the employment sort of under control. And again, I'm speaking really ethereally here. This is like an aspiration that we see, that the next step there is to take the South African consumer into our trust, for them to allow us to be a shopping destination for them, all things consumer. That is not sort of FMCG, that doesn't outlive the period that you have to repay it for, obviously, because that's not a logical approach to the use of money. And that would then empower us to be more meaningful and have this walled off garden, from the rest of the world, where we've got actual intelligence, demonstrable and actionable intelligence available to the market, rather than somebody just throwing heaps of money at a fan and hoping to see that it lands, in disparate corners of the country.
Listen, Mark, you got my head ticking now in terms of Web3 and how actually that can be sort of built into this kind of platform, and how actually consumers can be rewarded for data sharing and what have you. But that's one for another day.
It's more than that, Darren. It's more than that. Yeah. We can take this last couple of minutes and distill it into a strategy, and make it so that the consumer gets it straight away. Still experiments here and there with Team Machine, because you're getting it cheaper, but you're not gonna. It's not going to last long. That you regress into the median there, and then for the merchants to embrace it and say, listen, we need to close we need to pull up the bridge off the moat, and we need to close the gates, and we need to make sure the walls are high, and we need to look after what we have here, because we're under pressure enough, just in our country, let alone without these exogenous sort of attempts into our market.
It's a hard one though, Mark, isn't it? My fiance, she loves Shein and Temu, and she's a very proud South African. But I think there comes a point where you go, hang on a minute, I can literally clothe the kids, right, who are young, who are going to grow out their clothes before they wear it. I can do a whole wardrobe for $1,500, right? Or I can take my $1,500 and go to a retailer in a mall and probably get 3 items or 4 items of clothes. So I think that there is that reality there, and I'm not suggesting that the industry is burying their heads in the sand and saying it will go away. But I think there is this pressure now on retailers from consumers to go, hang on a minute, you're posting these incredible profits, you're hundreds of millions of brands, and you're saying to us, or SARS are saying to us, actually, we're going to impose higher taxes on foreign imports. hang on a minute, if you just kind of, reduced it a
Yeah.
little bit, and maybe use some of the tools that are out there. I'm not suggesting by any means that I'm advocating for retrenchments. That's the last thing I ever want. But I think these retailers could work smarter. Could, I think, lower costs. I think could use solutions like you guys have got and other solutions that are on the market to actually lower those fees that they're having to incur. I'm heavily involved in an EZAR program where you mentioned Visa and MasterCard and other rails and banks. That's a thing of the past, right? I can transact and it costs me basically nothing, right?
Yeah.
Basically,
Yep.
so I do think there needs to be my own personal view. I do think there needs to be a look at the economics, certainly around retailers here in South Africa. I think it does need to be more competitive. You mentioned, cost of living and how much that's gone up. I mean, it's crazy. I remember, doing a weekly shop in Woolworths and it costing, pick a number, 1,000 rand, right? And now it's like 1,500 or 1,800 rand for the same basket. All right, so you have definitely seen inflation, and I think that needs to be inflation needs to be addressed. Of course it does, but I'm not an economist and I don't work for the Treasury. But if we could look to help some consumers with solutions like yours, PayJustNow, BNPL, where actually you don't have to use all of your capital straight away. You can spread that over a few months. Whether we can work with retailers to try and lower their merchant fees that they're getting charged. Again, you're adding value, and I completely get that. But from a payments perspective, I'm going a little bit off topic here. Really, where's the value in a payment? A payment is a transaction. Adding value around that, I don't know. It's a race to the bottom. It's a race to zero, I think.
It is a race to zero, but I think to put a finer point, like one of the biggest things I fear is that when we talk about retailers, we're always thinking about the listed retailers who are posting those profits.
Yeah,
we're not talking about the entrepreneurs, the small operations, the emerging brands, that are up against the wall, and they aren't posting massive profits.
No.
And yes, the ones with the balance sheets and the sort of the boring JSE AGMs, they have made good money, but it's unit economics. But I think that the future of sort of retail and commoditized services where payment solutions like buy now, pay later, which isn't just a rail transaction, there's a lot more to it. The job economy and the sort of like your regional and your sort of urban, peri-urban type things is largely reliant on somebody that doesn't deserve to be swathed up in that same cloth. It's not them that are shutting down because of Timu and Shein eating their breakfast and they're not being able to advertise. It's the middle of the road, guys. And yes, I mean, if my two kids are going to grow out of their clothes in 6 months, then it would be stupid not to do that, right? So there is a place for everything. I'm not saying Timu and Shein don't belong here. I'm saying there's a place for it, and there's a niche for it. But it could be really, really terminal for a lot of small businesses that rely on sort of a market share, whatever size they have.
No, listen, you make a very, very valid point. And I think, if we look at, the population here, again, I don't have the exact stats, but I imagine it's a very high percentage of the population that don't go and shop in malls, don't go and shop at Walmart, don't go and shop at, Ackermans or whoever it may be, right? They're actually within the township economies and they're transacting within the township economies. So you absolutely make a valid point. And I think it's going to be interesting to see what sort of pans out over the coming sort of year or two. I think there's a lot of innovation coming, certainly in the world of payments. You guys are clearly doing a fantastic job, and I wish you all the very best. I'm sure we'll meet at some point face to face, and maybe I would have grown my beard by then. Who knows?
But, or I'll shave mine off.
No, I won't recognise you then. It'll be like looking in a mirror. It'll be like, no, don't do that. But listen, Mark, thank you very, very much. If there's any sort of parting words you'd like to leave, I mean, for merchants to who are interested in taking on PayJustNow in terms of a model, best place for them to sort of get some research is connect to you directly on LinkedIn or go through the website.
You're welcome. And PayJustNow.com, our webpage, has a for merchant section. It's very much the pay in 3. I'll leave you with one. The pay in 3 installments, where the name came from, Pay Just Now. It's very much a South Africanism.
Yeah.
If you say just now, if you're traveling, they won't quite get it. But just now is sort of like an expression of time, somewhere between now and sometime in the future. It's not really defined. And it's made up of now, and just now. That's kind of like the evolution of it. And playing on that, we came up with 3 installments, was the unit economics in terms of that. But also the trilogy of this is there's 3 stakeholders in this sort of platform ecosystem we've built. And we're at the core of it as the facilitator. And the second one is the consumer. And the third one is the merchant or retail partner. And this triumvirate, is only exists if all 3 do. And so it's the magic of the 3 in sequence, and there's some beauty to that.
So before I let you go, Mark, before I let you go, anecdotal story very quickly. When I first got to South Africa, I think I went to one of the electronic shops or whatever it was to buy a fridge or whatever it was. I can't remember. And I bought it, and they said it'll be delivered on the Tuesday. Okay. So Tuesday, like 10 o'clock in the morning, I called. I said, listen, like, what time's the delivery? He went, oh, no, be there now. I went, okay, great. So I'm standing outside. So I called him back and I said, listen, you said it was going to be like now. He went, no, I didn't. I said, it'll be now. Well, what does that mean? He went, sometime in the future. Okay, I'll go make a cup of tea and carry on with some work there. Thank you for, and then someone actually drew me out, just now, and right now. And so now I kind of understand it after a decade. But listen, Mark, thanks so much. Great chatting to you.
Lovely chat. Thanks, Darren.
Wish you all the best. And if we don't speak before, have a good Christmas. Wow. Yeah. Yes. Years flown.
Got to get past Black Friday first, then we'll tackle that.
Thank you so much.
Thank you.
All right.